Good afternoon, everyone. In today's video, we're going to talk about the volatility box setups that took place for today, August 4th, 2020. Today in particular, we had 6 setups that took place. 5 out of those 6 setups were winners, so a net winning rate of 83.3% for a net P&L of positive 1,052.50. Now, for the most part today, we had mostly winners. So the S&P, we had a nice winner. The Russell, we had a nice winner, positive 370. Crude, we had a nice winner, positive 580. Natural gas, we had 2 trades, both of which were winners. The first one hit T1 and T2, and the second one only hit T1, so that was a positive 440. And then we had one loser in silver, which this was a fairly large loser, which ate away into some of our profits, and that was minus 900. And this was before we even sent out that morning email, which is what really dictated, I think, the models that we use for the rest of the day. Now, the other thing that I'd also like to talk about in today's video are missed trade opportunities in the Nasdaq and the Dow. When I say missed trade opportunities, I mean we had breaches. We had price action essentially hit our sign entry line, but we never got the retest of the sign entry line that we're typically looking for before price action continued to hit its targets. And both in Nasdaq and Dow, they hit their T1 and T2, and so those were fairly nice trades where we did capture that with the S&P and the Russell. But the question starts to become, if you're looking to try and be a bit more aggressive with the Nasdaq and the Dow, what are some ways in which you could still try and play that move? So we'll talk about that in today's video as well. I think it should be a fairly informative video with some good ideas, at least that should get your head churning. All right, so starting with the S&P futures, we're on our Scalper Volatility Box here, right? That's the model that we were using. And now we had our entry come in that 11 to 12 p.m. Pacific hour, where again, price action fell perfectly into our cyan lines. We're then waiting for this edge signal. The edge signal came. We had an opportunity, in fact, multiple opportunities to enter at the cyan line or better. And that's our entry. Once that happens, our stop is outside of the volatility box. Our first target is what we risk, which in the case of the S&P futures was 3.75 points for the first contract, which is this distance on the other side. And then our second contract was at the gray target line, and that was 7.5 points away. And that ended up giving us both our T1 and T2, and that was a fairly nice trade. Now, the concept that we'll talk about for the Nasdaq and the Dow also translates here, but it's the idea of once price action really hits our T2 and stops, there's still a good amount of money that was left on the table in terms of taking off our contracts at T2. And so the idea starts to become, well, if you have 3 contracts or more, or conversely, if you wanted to try and find a way to take the same amount of risk, but say perhaps using options, how does that look? So we'll talk about that in QQQ and DIA, or at least Nasdaq and Dow when we get to that. But next up, let's first talk about the Russell, which gave us a very similar entry to the S&P futures. So with the Russell, again, we were looking for breaches as the day progressed. We came close in that 7 to 8 a.m. hour, but didn't quite hit our cyan entry line. Again, just ping-ponging back and forth between the levels, not really hitting either side's aggressive lines until the 11 to 12 p.m. Pacific hour again, where we had price action breach our cyan entry line. We got the edge signal. We had an opportunity to enter at the cyan line or better. And once that happened, the trade was a go. Our stop was outside of the volatility box, and we were looking for that same bare minimum first move target on the other side, which in the case of the Russell was a bare minimum move of 2.2 points for our first target. And then our second target was again at the gray target line on the opposite side, which in the case of the Russell was at 5.2 points. And so that's where we hit our T1 and T2. But to play devil's advocate to what we'll talk about with Nasdaq and Dow, that's where if you did try and use something like options to play a stretch target here, we really chopped around sideways, where if you are using options with say 3 days to expiration, that's where you would start to see a decrease in the options price as we're just chopping around sideways, especially if you've just bought premium. And so again, we'll talk about some ideas there. So now let's actually go to a chart of the Nasdaq. So now starting with the Nasdaq, very similar to the S&P and the Russell, we saw a little bit more volatility. So we had our first breach actually come in between that 10 to 11 a.m., but this was at the edge of an hour. So this is the point where we're just observing. We don't have any capital at risk. And we saw that this did in fact still continue to respect our models, and we saw the Nasdaq fell from the level we expected it to fall from. So that was awesome. We again continued to have more confidence in the models. Then we had our next breach of our cyan entry line, waiting for the edge signal, but that edge signal only came once price action had breached outside of our volatility box. And so at that point, that was our sign to switch on over to our aggressive models. So switching over to our aggressive models here, this was the model that did a much better job of containing price action, and that met our rules, right? We had price action hit our cyan entry line. We were still inside of our clouds. We had the edge signal, and this is where we're now looking for an opportunity to enter at the cyan lines or better. Now, we didn't see that opportunity in the Nasdaq before really the Nasdaq continued to make its way up higher, where in the case of the Nasdaq here, because we are on the aggressive models compared to something like the scalper on the S&P and the Russell, that also gives you more stretch targets, right? So for example, in the S&P, we had a max T2 of 7.5 points, which if we translate that to dollars, that's 375 bucks. In the case of the Russell, that T2 is much greater, right? The T2 here is 64 points, which is 1280 per contract. So the question starts to become, how do you still try and participate in this move without overpaying? And so that's where, for those of you that are looking to try and be a bit more aggressive, here's a couple ideas that you may consider employing. The first is obviously whenever we do see that we have an edge signal that takes place inside of this zone without giving you the opportunity to enter the sideline and you're looking to try and be a bit more aggressive, that's where this zone and using the micro futures instead of the full size is one opportunity. That still does require you to use futures as the asset class, whether it's micro or full size, which also comes with the commissions that come with this. And so your alternative there is to try and use QQQ, which if you notice QQQ in that same time frame maps fairly well to our actual trade entry, right? We had our breach, we then had our sign entry, and then the edge signal. Now, the futures is the chart that we'd be using to manage this, but you now also get an idea where if I come back to a chart of the Nasdaq futures here, if you say had taken this, the second way that I think is an interesting way to try and play this where the risk reward is skewed in your favor is to use the T2 line as the place in which you're targeting the out of the money calls in this case, or whether it was out of the money calls or out of the money puts, or a slightly in the money put credit spread if you're looking to essentially sell premium, where in both cases you're taking the play which traditionally has lower probabilities associated with it, and then you're stacking that with the volatility box to try and again increase those probabilities in your favor, where in a lot of these cases the risk reward then starts to become skewed in your favor. So to give you an idea of what that looked like with the Qs, that's where if I come back to the Qs here, our Qs at T2 target line was right around that 269.70 zone. And so if you came into the QQQ, and that's where you had the choice to use either the 269s or the 270s, we said 269.70, right? So if you use the 270, which was a nice round number, which also had the higher volume and open interest, that's where if I come in, I copy this options chain to give you an idea of what that move looked like. While you do have an idea that the futures with leverage was about positive 1280, the option, you had an opportunity to enter for right around that $1.85 to $1.90 zone, right? So somewhere in this zone. And the T2 target, which you also had ahead of time, given the fact that this is trading a good number of contracts, 16K plus contracts, you have data, which then translates to candle-like charts, which again lets you map out a very similar zone using the actual option chain of where that T2 line would take you, which is close to that $2.40-ish area, which would be the target that you're looking at. And so from a percentage basis, that's a gain of, let's say, right around 50 bucks on a $190 investment, which is a 26% return in, what was that, right around an hour and 45-ish or so minutes, right, into the close. And that starts to give you an idea of how you can use options where your initial risk could be scaled in chunks of $1.90, where again, you're not risking the full $1.90, but in fact, you're risking something more like $30 or $40. And it gives you an opportunity to try and play similar risk as the micro futures, but be able to hold for a slightly longer period of time if that does so suit your scale. Now, I do think that the micro futures offers you the opportunity of very precise pricing, right? So if you were trying to still reduce your risk, you don't have to mess around with any of this options pricing. You know exactly where, say, the entry line is. You know exactly where the great target line is. And you also know exactly how much you are overpaying. The only difference is that overpaying becomes a little bit more trivial with the options compared to the actual futures, right? You're still overpaying by right around 10 points on the Nasdaq, which does start to add up after a while. And so that's some ways that you could try and play this. And then finally, the last way that I'll talk about is, again, just using the pure ETF. Now, the reason why I think this is more interesting sometimes than the micro futures is because it's commission free, at least on Thinkorswim and most major brokerages now, where once this starts to become commission free, you start to take a look at, okay, well, do I want to buy some shares of QQQ, which, yes, while it may be more expensive, I know a lot of you do have the capital. You just prefer using micro futures as that is really doing a better job of accommodating your risk. Well, now using the ETF and scaling in based off of whatever shares make sense for your account gives you the opportunity to have a commission-free trade. All right, so hopefully that tangent gave you some good ideas around how to use options for the Qs. And if we look at YM, the Dow is again very similar as well, right? On our scalper models, we had price action breach our sign entry line. We had the edge signal, but we never got that opportunity to enter the sign line or better, but it did lead to a really nice reversal. And so it's, well, what are some ways that we can still try and take advantage of this? And so that's where those ideas hopefully get your brain stirring just a little bit. You can also start to skew the risk reward in your favor by using things like data in your favor. So for example, on Fridays with 0 days to expiration, that's where you can now start to sell spreads where you have the data really working in your favor, where a lot of these times, if it's slightly in the money, you're risking something like 1 to make 2, which really starts to make sense, especially after some of these moves compared to using the micro futures. Of course, the full-size futures will always have the best leverage possible, at least in my opinion. Now, moving down the line, we had another trade in crude. And so crude, we started off with our Doomsday Aggressive models. That's the one we sent out in our note. And again, looking for breaches. Now, we had the breach take place in that 10 to 11 a.m. Pacific hour, where we had price action breach our cyan entry lines. We had the edge signal. We had plenty of opportunity to enter at the cyan line or better. Our stop was outside of the volatility box. And our first target was the same thing that we risked, which was 16 cents on crude. And so we ended up hitting that 16 cents almost right away. That was a fairly heat-free trade for the most part. We did go a little bit into the clouds here, but outside of that, we didn't really get close to the outside edge of the clouds. And 42 is that natural resistance zone, is where these clouds also overlapped with. And so that held fairly nicely, giving us both a T1 and T2. The T2 in crude here was closer down to 42 cents if we extrapolate this. And that target was hit into the final hour before the close actually happened. And so that ended up being a fairly nice stress-free trade in crude. Now, if we move on to silver, silver was not so stress-free, right? So silver, the trade opportunity came as price action breached our cyan entry lines. And so really, if I start off with our aggressive models here, that's what we were using, still headed in from 7 to 7:30. We had volatility quickly start to pick up in silver, where price action breached our cyan entry line on the aggressive and very quickly went outside of the clouds on the aggressive before giving us this edge signal. So that then was our sign to switch on over to our doomsday models. The doomsday models at that time did give us the edge signal, did give us an opportunity to enter at the cyan line or better. In fact, we had an opportunity to enter at the clouds, and that trade in silver ended up becoming a loser on both contracts, which is where that loss of 900 came in. And after this point, we were then just going down the line to try and see, well, do any other models do a good job of accommodating price action? So switching to the conservative, still price action went outside of the clouds, and switching to the doomsday conservative, same thing as well. And so that was a sign that, hey, silver is really much more volatile than our models can handle, and this is our sign to sit out the market. Now, if we contrast this with gold, this is where that note of we expect greater volatility to start to come in also takes place, where using our aggressive models here, we had price action breach our cyan entry line with gold futures. We were waiting for the edge signal, which only came after price action broke outside of the clouds here. And so that then took us to our doomsday aggressive models. Again, still broke outside of that. That took us to our conservative models, which we saw that now we had breached the cyan line, had this edge of our entry. And if we draw this out as a line in the sand, this is really where, without having capital at risk, we're waiting to see which way does price action break. Do we see this bare minimum move take place in gold first, which again gives us this idea that at least the sellers have some sort of control and our models can be respected? Or do we conversely see that price action breaks outside of our clouds, which is really what happened, not in this candle actually, but it was as price action started to drift up higher, closer to that lunchtime hour, 9 a.m. Pacific. And so that's where that was our sign to switch over to the doomsday conservative models. And switching even to the doomsday models, we broke outside of even those clouds before hitting that first target. And that was then the sign, again, like silver, gold was no longer tradable. Volatility was exceeding our clouds. We didn't really have any kind of edge there. And then finally, we'll conclude with natural gas. And so natural gas, we were on our doomsday aggressive models here. And so natural gas, if we take a look to see where we had our breaches, we had a couple breaches. So in that first hour when we were looking for our test, we saw really a nice ping pong sort of movement. And so that gave us, again, confidence that these models are being respected. The next hour, we didn't see any breach. The next hour, we did see a breach, but we didn't get an opportunity to enter at the cyan line or better after that edge signal. And in fact, here, options wouldn't have made a whole lot of sense either. Quite a bit of ways from the actual entry point. So still looking, but we did make that actual move. So still building confidence in the models. And the next entry came in that lunchtime hour where we had price action first breach our upper end of the volatility box, where we had price action breach. We then got the edge signal along with an opportunity to enter the cyan lines or better. And if I zoom this out here, you'll see that our stop was outside of the volatility box. First target was 12 natural gas ticks. Second target was at the gray target line, which was 20 natural gas ticks. Both T1 and T2 were hit, and as T2 was hit, we breached our cyan line one more time. Again, looking for another long entry now. So once we breached our volatility box cyan entry line, that happened before that 950 mark, so before the edge of the hour. Then we had an edge signal right here. In fact, we had multiple, along with plenty of opportunity to enter at the cyan line or better. And that was then our second trade in natural gas. We're stop again outside of the volatility box. Same target as a short, so our first target was the same 12 natural gas ticks. And our second target was at the gray target line on the opposite side. But in the case of the second target here, we had price action fall, hitting that cyan line, stopping us out of that break-even stop before ripping up higher. And so that didn't really give us that T2, but it did give us that T1 for that second trade in natural gas. All right, so I hope this video helped to give you an idea of all the breaches that took place today. We had quite a few, and then we also had some missed opportunities where hopefully the discussion around ETFs, options, all that good stuff at least helps to get your mind thinking a little bit in terms of different ways that you may be able to play it that fits your trading style. All right, hope this video helped. Take care, everyone. Good luck trading, and we'll see you in the next update.